Good evening, ladies and gentlemen. I'm Russ Mould, AJ Bell's Investment Director. Thank you for your time this evening. As with the previous sessions that we've done, I'm going to present for around 20 minutes. And after the presentation, I'm going to open up to a question and answer session. You can ask questions at any time during the presentation in the questions box within the panel. Please don't be shy. These questions will only be seen by the glamorous moderator sat on my left here, and I'll choose a selection to answer at the end of the Q&A set at the end of the presentation. I've already got 3 in, by the way, so we're off to a quick start there, but I will do my best to answer as many questions as possible. If at any stage you have a technical problem, I know we had some small difficulties with the sound last time, please use the questions box again to speak to us, and we'll help you out as quickly as we can. And at the very end, you'll receive a small request to fill out a survey form, just let us know what you think. And again, that will also, most importantly, give you a chance to ask any follow-up questions if you were feeling shy or something occurred to you when you were contemplating what we've had to say later on. So in the interest of everybody's time, let's crack on. So this is what we're looking at. We're looking ahead to the markets in 2017, a few famous faces there. There we go, we're in business. So just to very quickly go through the risk warnings, all important. I know they can be slightly heavy weather, but they are very, very important. So just please look at those for a second, particularly perhaps the bottom one. Here's the Roman god Janus looking backwards as well as forwards. We're going to the backwards first, then the forwards before moving on to the all-important Q&A. And again, just in case you didn't hear the preface, the opening remarks, I'm going to speak for about 20 minutes. You can ask questions at any time using the box within the control panel. Don't be shy. Nobody will see your name or your identity. I'll choose which ones to answer, hopefully all of them. But if you are feeling shy, there will be an opportunity to ask questions afterwards when you fill in the survey form, and I'll reply to you directly myself. And if at any stage you do have any technical problems, please use the questions box to speak to us, and we'll help you as quickly as we possibly can. So let's start looking backwards with our friend Janus here at 2016. 5 key trends: Brexit, growth and inflation expectations rising. Had we been here a year ago, we'd have probably been worrying about deflation and a triple recession. A lot of market volatility 12 months ago, a long time ago as it may seem. Dollar was king throughout the year. For many asset classes, the darkest hour proved to be before the dawn, as many downtrodden old favourites came back into fashion, and there was a huge range of stock performance last year, which presented opportunities as well as the inevitable challenges. So Brexit, we can see here from the sterling trade weighted basket on the right hand side, data you can get for free from the Bank of England. The pound was already wobbling going into the referendum vote, took a real hammering coming out of it, but perversely that was the making of the UK stock market in 2016, at least for the FTSE 100, which derives 2/3 of its earnings from overseas. Because of the weak pound, that increased the value of overseas assets, overseas earnings, boosted exporters as a result, and therefore exporters and overseas players beat domestic stocks hands down from the end of June onwards. And of course, the other thing not to forget is that holding overseas assets worked very well. If you were an investor directly invested or indirectly invested through a fund in overseas equities, bonds, or property, you got an instant lift from the lower pound. So in some ways, the ultimate Brexit trade was to hold your money overseas, but if you had money domestically, the action was very much in the exporters and the overseas earners. I'll show you some data on all of this to back it up. Secondly, growth hopes began to rise again. It actually didn't start with President-elect Trump, but he certainly accelerated the process. In some ways, Brexit started it. I think politicians are sensing it's not just their, politicians are sensing it's not just the people's jobs are on the line here, it's their own. People are pretty fed up of austerity. There are clear concerns over the pace of economic growth, wage growth, and I think that has started to prompt a move away from austerity towards fiscal stimulus. We're all Keynesians now, we could argue, whether this is Theresa May, she's made talk about infrastructure investment, President-elect Trump has. We've also seen it in Canada, in Japan, for example, and this reflation or Trumpflation or inflation trade has seen a clear preference from the middle of the year onwards, not just from November, for stocks over bonds. Bond yields rose and therefore bond prices fell. Equities rose, and one way in which you can track this is to look at the chart on the right hand side here, where I've divided the share price of the iShares Core MSCI World ETF by the share price of the iShares Global Government Bond Exchange Traded or Tracker Fund vary the tickers. You can have a look at SWDA and IGLO. Divide one by the other, and when the line goes up, equities are outperforming. When the line goes down, bonds are outperforming. And as you can see, post Brexit, equities were in charge. Post Trump, they've really taken the lead. The dollar, I said it was king throughout all the year. Actually, it did have a bit of a snooze during the midpoint, but in fact, and that was when it was initially the dollar responded to the Fed's first rate hike in a decade in December 2015. It then had a bit of that snooze because the Fed didn't follow through on its plan to put through 4 interest rate increases in 2016. It managed just the one, but again, encouraged by that rate rise and also the Trump trade and the prospect of stronger US economic growth, the greenback really took over in the fourth quarter of the year, not least because as America was tightening monetary policy, the UK, Japan, and Europe were still running ultra loose monetary policy and even running QE schemes. So the dollar ended the year on a tear, further emphasizing the advantage to domestic UK investors of dollar earners, overseas earners like the miners and the oils, for example. So 2016, fourth trend, the darkest hour coming before the dawn. And this is classic contrarianism, doesn't always work. But in 2015, what were the big disasters? Well, it was oil, commodities, resources, stocks, and emerging markets. Banks were also out of favor under the burden of regulation and competition from the challenger banks. Lo and behold, what did best in 2016? This is looking at the S&P 1200 global sectors, but I could do it for the US stock market, Europe, or the UK, wouldn't matter. Energy and financials generally led the way. Again, that partly reflects the big shift from bonds to stocks, and within stocks, from quality growth and expensive defensives like healthcare, utilities, consumer staples, sectors you can see on the right-hand side of this chart, towards turnaround stocks and cyclicals, energy, financials, industrials leading the way. So it's often the case just when everybody's giving up, the wet towel comes slopping into the ring. What has become unloved has potentially become undervalued, and it doesn't always then take an awful lot to change market perception. And it was a great year for value funds. I know there's been an awful lot of bricks thrown at it, but Tom DeBell's M&G UK Recovery Fund, for example, I think has been a regular in the Spot the Dog survey that's done by one of our competitors. That fund is actually now currently top decile, intriguingly. And the fifth and final trend for 2016, a massive divergence of stock returns. I'm looking at individual sectors here, but as monetary policy diverged between the US and the rest of the world, as bonds fell, equities rose, commodities rallied, it was a chance for active fund managers to shine. Though looking at the statistics published by the Financial Times recently, they didn't, unfortunately, with the majority of active fund managers in the UK and US underperforming, and that's why fund flows into passive funds like ETF set record highs for the third consecutive year. But nevertheless, there was a huge divergence in performance. This just looks at the 39 sectors that comprise the FTSE All-Share, or at least the 5 best and the 5 worst. And as you can see, you've got a range of up to 135 to down 21, with again cyclicals, turnarounds, dollar earners at the top, defensives, stodgies, domestic-facing sectors at the bottom, all very much part of the clear trend. And just to crystallize the 5 themes that I've talked about there, these are the final scores on the doors for 2016. By asset class, commodities and global high yield debt actually did best. Government debt did worst, again as inflation fit growth hopes began to rise. Emerging markets did best, followed by developed markets, helped perhaps a little bit by the commodity recovery, but certainly by the overall recovery in appetite for risk. And by region, this is just worth bearing in mind, the impact of sterling. I said earlier on that holding assets overseas was probably the ultimate Brexit trade. This writes that trade large, it makes it clear. The FTSE All-Share did well last year with a 13.2% capital gain, and yet it was in fact the worst of the major indices that I've put up here, all of which benefited from the decline in the pound, which made their value higher once translated back into sterling. And again, just to reinforce the importance of commodities, of inflation and growth expectations, and of emerging markets, look who came out best last year, Eastern Europe and Latin America, the two areas that actually done worst in 2015, again, the darkest hour being before the dawn. And by stocks, I've already emphasized the wide divergence by sector. This is just within the FTSE 100, as you can see. Anglo-American up nearly 300%, Capita down 56. Again, clear trend, exporters, overseas earners, overseas assets, commodities, and dollars on the left. On the right, domestic plays, and none of the trends that have applied to those on the left primarily. That's for the whole of 2016. For the second half only, if anything, those trends become even clearer, particularly the move from expensive defensives like Vodafone, Imperial Brands, United Utilities, National Grid on the right, to the cyclicals, the dollars on the left, the industrials like Ashtead, the banks like Barclays and HSBC. Very, very clear trend. It was beginning before Brexit, became even more profound after that and after the Trump election. So that's what happened. I'm particularly good at telling you that because it's dead easy. I just need my Thomson data stream terminal for it. But let's get to the real secret now, the real interest, I'm sure. What does Janice think looking forwards? And I think some of the themes from 2016 will persist, but my big five for 2017 would be the dollar linked to the Fed and President Trump, bonds, emerging markets, Brexit, and the banks. So let's start off with the dollar. Again, it's trading at over 100 on a trade-weighted basis. We've had a look at the chart earlier on. The Trump trade is key. What can he achieve? Will Congress get in the way? And by when? Are there any shovel-ready products? What tax cuts can he push through, both corporate and personal? And what will companies do with the money that they are going to be allowed to repatriate? Will they invest it? Will they acquire with it? Or will they do stock buybacks with it? We'll have to see. One question is, there is a suggestion Trump will be making interest on debt. He will remove the tax deductibility of that as a quid pro quo. That will certainly make share buybacks much less attractive and would potentially tempt companies to pay down their debt, which actually would probably be quite a good thing for corporate bonds. Probably wouldn't be a disaster for equities. It would make company balance sheets less risky. So let's see. But if faith in the Trump trade and the growth trade persists, you'd expect the dollar to continue to be strong. And then the rest of it will then depend on what the Fed does. The US Central Bank is planning 3 0.25% rate hikes for 2017. This rather messy chart on the right-hand side shows you what the financial futures markets are expecting by way of where US interest rates will be at each Fed meeting, all 8 of them for this year. And as you can see, just looking at the coloured bars, looking at the all-important light grey bar, the fourth one up, that 1.25 to 1.5% range, that implies 3 rate rises this year, and the market's putting around a 25% chance on that, no more. And it's putting only a 50% chance on the first rate hike coming by June. So the market at the moment is still saying to the Fed, don't really believe you. So if the Fed moves quicker than that, that will be very, very pro-dollar. But even if to some degree the Fed does nothing, and the UK, Japan, and Europe stay in easing mode, that could still be enough to keep the dollar going. And although the dollar is at about 103, 104 on the index trade weighted, it did get to 120 in 2000 and over 150 in 1985. So it could go a heck of a long way further. But if that does happen, then the Trump trade could actually short circuit. Because if you think about it, a strong dollar is potentially deflationary. It certainly makes US exports uncompetitive. And it also would, and also if the US economy really does go nuts, it would probably drive bond yields up further still. And higher borrowing costs and a higher dollar you would expect would crimp the US economy. So there is a danger the Trump trade short circuits, but I think that's probably an issue more for 2018 than for 2017. Bonds, we've already touched upon them. There were, we've had a 30-odd year bull run in bonds, and they did brilliantly in the first half of the year, and then got really carried out in the second half. Stocks and the dollar have welcomed the Trump and inflation trade. Bonds, understandably, haven't. Obviously, bonds in many cases got to negative yields. You actually paid the lender the privilege for owning their debt on certain government bonds by the middle of the year. I think that does now look like a major aberration. But whether a 1.5% 10-year gilt yield or a 2.5% US 10-year Treasury yield prove tempting or not is one of the key issues of the year. not least because there are still strong deflationary trends at work for the long term. Debt, demographics, the dollar, internet. I mean, demographics, we all tend to spend less as we get older to make sure we run out before the money does. And debt is inherently deflationary because we have to pay it back and the interest sucks money away. So there are still some very powerful trends out there, but it is interesting to see wage growth creeping up. Bill Gross of Janus, ironically, actually says in his blog today that if the US 10-year Treasury goes above 2.6% yield, then he thinks the bond bull run could indeed be over. So let's see. But looking at this, 20-year chart we've got on the right-hand side here of the UK 10-year gilt yield, we've had 10 fairly substantial sell-offs in UK gilt yields, UK gilts, price down, yields up. They've all fizzled out because in the end, growth has continued to slow, and also these strong deflationary trends have continued to gather. So there are no guarantees, but this is one of the key challenges for bond investors and anybody with a balanced portfolio in 2017. What do you do with your bonds? Do you step back in if yields get to a certain level, or do you really start to take flight if inflation picks up? Emerging markets, well, very much linked to the previous two discussions of growth, inflation, and Trump. Commodity recovery has been a huge benefit to emerging markets. Oil for Brazil and Russia, iron ore for Brazil, for example, sugar for Brazil, oil for the Middle East. Political reform hopes, Brazil, Argentina has been strong as well. Interest rate cuts across several markets, even Brazil got in on the act at the end, all helped come out emerging markets in 2016. We can see on the right-hand side how the MSCI Emerging Markets Equity Index, close historic correlation with the Bloomberg Commodities Index. So strong oil, strong iron ore, sugar, copper, you name it, should in theory be good for emerging markets. However, we do know from history that a strong dollar is traditionally bad for commodity prices. Again, no correlation is perfect, and we know that, as per the risk warnings earlier, past performance is no guarantee for the future. But a strong dollar is in theory bad for commodities because it makes commodities more expensive for countries who don't use the dollar as their currency. And therefore a strong dollar is traditionally bad for emerging markets. However, there is a Bank of America Merrill Lynch survey which points out that 1/3 of the time when the dollar has been strong since 1970, commodity prices have also been strong, and emerging markets did well during that period. So it's a rare but potentially good sign that at the moment commodities are firm and the dollar is firm. So let's see. Emerging markets did underperform in 2012, 13, 14, and 15 before rallying in 2016. So let's see whether this is the start of a big new bull run to match that, say, of the early 90s or the early 2000s, or whether it was just a flash in the pan. If commodities stay firm and the dollar weakens, then you're probably off to the races with emerging markets. But nevertheless, strong dollar will be a test for them because a lot of their debts are at sovereign level and indeed corporate level are in dollars. So again, they become more expensive to service if the greenback keeps going up. Brexit, we're going to hear so much about it. I don't want to talk too long about it just in case you're sick to death of it already. But we've got Article 50 due to be invoked in March. And whether Prime Minister Theresa May is fed up of the adjectives hard or soft Brexit, the market's going to continue to weigh on that, think heavily about that concept. We even saw yesterday, as soon as the phrase hard Brexit was mentioned, sterling lost around 1% against the dollar and the euro, to the benefit, though, of the FTSE 100. I suspect that Theresa May is in a bit of a hurry, if only for, I'm afraid to say, for naked domestic political purposes. The negotiation process is supposed to take 2 years. So invocation in March will end the process by 2019 and give the PM, who, let's face it, has never won an election to be PM, at least in terms of a general election, it'll give her a clear run at the 2020 vote, which is probably what she'll be looking for. Soft or hard, whether she likes the terms or not, that's the way the market's currently looking at it, fairly binary, and it'll be very important in shaping the direction of trajectory of sterling, and therefore whether overseas players keep outperforming domestic stocks or not. And certainly talking to lots of UK fund managers, they think that what value is to be had in the UK now comes from more of the domestic players. The trick, of course, is finding the catalyst to unlock that value. Next seasonal stink bomb last week didn't get us off to a great start. Morrison a little bit better today. Let's see how that continues to develop. But sterling will clearly play a huge part in shaping sentiment. One thing that you can say as well is that sterling will have a strong say in key sectors like oil and gas, financials, Consumer staples. Staples obviously very heavy with people like Reckitt Benckiser and Unilever. And this chart on the right-hand side shows the forecast contribution to 2017 FTSE 100 dividend payments. So a quarter come from oil and gas, just over a fifth from financials. So they're the key sectors to watch when it comes to earning to dividend payments in cash terms or in script terms. The line shows dividend cover for those sectors. And as you can see, for the biggest contributors, it's less than 2, which really isn't something that you want to see. So the higher the oil price goes, the safer the FTSE 100's 4% dividend yield is, funnily enough. So that, again, that's why it's such a key trend to watch for 2017. And finally, we've just talked about financials. The banks, unloved, heavily regulated, facing competition from Aldermore, Shawbrook, Virgin, you name it, they're out, Metro, you name it, they're out there. The banks have been under the cosh for some time, and you can see that in their earnings chart, which is the right-hand side. This is the aggregate pre-tax profit figure for the big 5 in the FTSE 100. There've also obviously been lashings of, literally lashings of fines for PPI and other misconduct. Now, what's interesting here is that analysts have slightly thrown in the towel after 4 or 5 years in a row of predicting that the next 12 months would see a return to the 36 billion plus pre-tax profits of 2007. They've given up. Don't think it's going to happen now. Intriguing. So certainly sentiment has become pretty washed out in that respect. The stocks, with the exception of HSBC, trade on less than 1 times book value. That's why the stock surged in the second half of the year, helped by rising bond yields, which steepen the yield curve, make it easy for banks to lend, to borrow cheaply, lend out more expensively, pocket the difference between the yields that they pay and that they earn, and that is definitely was potentially a way of rebuilding their net interest margins and profit margins. Banks are still cheap, albeit for a reason. We don't know what Brexit's going to mean, whether they can passport their financial services products into the European Union. We don't know what it means for the broader UK economy at all. HSBC and Standard Chartered, we don't know what's going to happen in emerging economies this year, whether China will slow down or not. There's some, and the regulator hasn't gone away, take it from us, and competition hasn't gone away either. So the banks have still got a lot on their plate, but expectations are low, and if they continue to surprise on the upside, then that would be a big plus for the index, for the FTSE 100 index. We've seen it's a big chunk of dividends. They're also a big chunk of earnings and earnings growth going forward for 2017. Key sector in shaping performance, and at least profit forecast suggests analysts have given up. So they're my 5 key themes for 2017. I'm going to be cheeky and slip in a 6th, complacency. The VIX index, the volatility index, is very low, very, very subdued vol. And as we can see, you can look at these quotes at your leisure, but as Jim Rogers, the legendary American investor and author, once said, the more certain something is, the less likely it is to be profitable. And right now, I think it's possible the market has just switched a little bit too quickly from deflationary phase a year ago to inflationary hopes right now. So let's see how that pans out. And in the end, we still don't know what the future is going to hold. So I've shown these charts before. I'll keep it quick. We still could get inflation. That's where the market's voting now. But the deflationary pressures haven't gone away. So this struggle continues. And each one, in theory, looking at past performance, will require different portfolio solutions. It's certainly interesting to read lots of people in the FT, from Baroness Altman down, talking about cashing in their DB pensions and switching them into DC schemes. I can see why they're being offered huge multiples to make that transaction. But A, you're going to have to take financial advice before you do it. B, you need to think about where you're going to put the money if you run that trade, because you're implicitly saying, I think bond yields have bottomed, I think bond prices have topped. So if you do then run the money, you're implicitly saying to yourself, I'm going to run a 100% equity portfolio or equity plus alternatives. Whether you want to take that risk will depend again on your own personal financial circumstances, your age, your time horizon, appetite for risk, and all the rest of it. But certainly if you make that trade, you're coming out very strongly on the left and on the equity side, much more so than on the right-hand side. If the world turns Japanese, it could be the wrong trade to make. You might still need to be on the right-hand side of the chart. And just a final point, as we all know, in the end, we all spot a good story, we all know a good story, but it's the price you pay to access it that matters. And valuation in the US is still lofty, pretty much record high market cap to GDP. Same in the UK, as you can see on the left-hand side here. The saving grace in both cases is that corporate profits as a percent of GDP are also at record highs. If they stay there or go up, valuations can be justified. But if there's any wobble, there's very little margin for error, very little scope for disappointment, room for disappointment on the downside. So if earnings growth doesn't come through, if the Trump trade doesn't work, if the world does turn Japanese, things could get quite messy quite quickly. So yes, the enthusiasm for the Trump trade is understandable, but always bear in mind that there are risks there. Because in the end, much as I'd love to have a crystal ball, I don't. So portfolios do need to be, and unfortunately I fear neither do you, unless there's something you're about to tell me on the question session. So portfolios do need to be prepared for a range of eventualities and not just one. It's too early to tell the full macro effect of Trump and Brexit, despite the clear market shifting narrative from monetary to fiscal stimulus. We're all Keynesians now, from deflation to inflation. And in the end, other factors are going to have a huge importance in the long run. Remember, Trump may only be in charge for 4 years, maybe 8. Equities, the real power of dividend reinvestment comes to force after 10, 15 or 20 years. In that respect, Trump's just a bit of a blip, potentially, even if he does wonderful things and sparks Reagan-style reforms, who knows? And in the end, it's corporate profits and cash flow that dictate valuation, and if it's valuation dictates return, so either do that work yourself or get a skilled fund manager to do it for you, depending again on which way you'd like to do it. But at least this explains the route in expensive defensives right now. Even if they were good companies, they were potentially overvalued companies for what they're capable of. And in the end, if in doubt, do nout, because excitement and expenses, as Buffett put it, are still probably your biggest enemies, because any trade you make will incur commission, potentially tax, spread, and other frictional charges, which will ultimately erode your portfolio returns. So certainly, don't start, if you are in doubt, sitting tight is probably the best thing that you could do right now. So thank you very much for your time. Sorry about the early technical problems at the start. I've already got 3 questions pre-asked here in front of me. I'll deal quickly with them, and then my assistants here will help out us take any other further questions. So please, again, don't be shy, whip them in. And if I don't get to answer all of them, and believe me, I'm going to have a really good go, I will make sure that you get a personal email to take care of them. So first question. Do you think I'm right in thinking that equity markets are assuming that while Trump may cut taxes and increase infrastructure spending, he won't introduce the promised significant tariffs for fear of sparking a trade war? Well, I must admit, I don't personally approve of a president, and not that Trump's going to give a monkeys, I can assure you, of a prime minister bullying companies by means of Twitter. Using Twitter full stop is pretty tedious. Trying to set policy by it, I think, is not acceptable. If there's going to be a law, then he needs to get on and set it, which I'm sure he'll be looking to do from the 20th of January onwards. So I view that as fairly reprehensible. Equally, I can understand what he's doing with the car companies. I can see why he would do that, and it seems to be working because Ford, GM, and Fiat Chrysler have already all toed the line. The US tax code's a mess. It needs to be reformed. Infrastructure spending, we're talking about $1 trillion of new spend potentially over a 4 to 10 year period in a $19 trillion economy. It's not that big a deal, to be honest. So I'm not sure that's necessarily the ultimate win that people hope it will be. And tariffs, there are very, very few things upon which economists can agree, but they all agree that the Smoot-Hawley tariff reform of the 1930s and the imposition of them in the US was a bad thing. So I think for the moment, you're quite right. The markets are assuming Trump will cut tax, he will cut regulation, he will increase spending, and they're sweeping the tariff thing under the carpet. I would like to think that he will see sense, because history is against him in terms of imposing tariffs as a good thing. And if he does, and I was Chinese, the first thing I would do would be let the renminbi float, i.e. sink, and try and stick it up him. Because if he's going to accuse me of being a currency manipulator, they might as well get on with it. And I think that would make it clear that the tariff game is a zero-sum game, and one that's not worth trying. So yes, I think if he does get serious on tariffs, then I think the market's enthusiasm may start to wane slightly. Second question, what's my view of 1 to 5 year corporate bond ETFs as a relatively safe place to park some funds while political events become clearer? I think that's a good one, and I think relative is the correct word to have used there, madam or sir, whoever's question it happens to be, because they're not completely safe, but yes, you will get a better yield than you will parking it in cash. You will get some considerable degree of protection from rising bond yields and rising interest rates, but not entire protection. One other option that you might like to consider, and it's one way you'll need to do your own research to see if it's suitable for you, you can look at inflation protecting your portfolio through index-linked bonds. They're not easy to buy personally, but there are funds out there. or indeed global fixed rate bond funds. James Tomlins at M&G runs one, for example, that's now got over £1 billion in assets, and that's got an effective duration of less than half a year. So that might be another option to consider if you think that's what you're looking to achieve. Third question, there seems to be developing consensus that 2017 could present difficulties for the UK population. Currency-led inflation, possible rate increases. Yes, I think that's right. That's why the general retailers have been performing so badly. The sector's been an absolute dog. If you look at the chart, there's a very clear negative reverse or inverse correlation between general retailers and the pound-dollar rate. The pound is strong, the retailers do well. The pound is weak, the general retailers do badly. I'm not saying that relationship's going to last forever, but it has lasted for the last 20-odd years with the odd lump and bump. So yes, if you did see a big spike in inflation, faster than wage growth, that would potentially crimp consumer spending. Rate increases, yeah, then people's mortgage bills go up, their credit card bills go up. Again, that's when it gets tricky for the domestic consumption stock. So that's where the pain has been. The market may be a little bit ahead of us there, but if those trends continue, those stocks could continue to suffer, even if on the face of it, they're starting to look cheap. It certainly would do nothing to persuade people to abandon the dollar export trade that is currently leading the way. So we've got a torrent of questions here. So let's start off with, is it possible QE will be phased back in Europe and Japan and the taper impact? Gosh, Japanese monetary policy is so confusing. I wish I spoke the language because it would help me pick through it. But the Bank of Japan's target to hold the 10-year Japanese government bond yield at 0 was interpreted by some as tightening. I don't think so, because in the end, now if you look at it, US bond yields have gone up, UK bond yields have gone up, Eurozone bond yields have gone up. The premium over Japanese bond yields is widening, and in theory that will start to act as a gravitational pull on Japanese bond yields and pull them up. So if the Japanese want to keep the 10-year yield at nil, they're going to have to write an awful lot of big checks and buy an awful lot of government bonds. So I actually think that's QE writ large. So no, I don't see Japan tapering right now. Could Europe taper? Well, they've cut the amount back to 60 billion euros a month from 80, but run it out to 20 to December. I think the European economic data is looking a bit more hopeful. I wouldn't get too carried away, but again, if they do stop tapering, you would expect bond yields to start rising. It'll be a big test for the weak peripheral banks in Europe, for example. So I certainly don't see Japan doing so. So if anybody's got exposure to Japanese equities, you need to be careful of the implications for the yen, which are probably negative of QE forever. But I think if Europe does it, then great. I mean, in the end, hopefully they can both taper, because it means their economies are getting back to full health, and that's got to be a good thing. But I'm not convinced right now. Theresa May says she'll tackle markets that don't work for consumers. Which sectors do I feel will suffer? That's a trick. I mean, I'm sure she'll be looking at the utilities, interesting, though we've got a huge review coming up of the water utilities this year, where the government may be introducing competition for water customers. It's not happened before. It has happened in the US, and it's funny enough, there's actually research out there saying it could be good for the utilities, because the utilities would innovate with product, they'd innovate with packages, they'd potentially invest in the network, and if they wanted to invest and innovate, the regulator might have to cut them some slack and actually let them raise prices. Now, for consumers, you might think, oh dear, that's not so good. But for the water utilities, if margins are allowed to rise a little bit as they fight over consumers, that might not be a bad thing. So funnily enough, I know that one or two brokers out there are looking at the water stocks right now. They're massively out of favor because they're seen as bond proxies, and we've been talking about bonds selling off. But again, they do have a pretty reasonable yield that is adequately covered from a utility perspective, about 1.2 times. If there is a consumer sector to look at in a backwards way around where it might be the water stocks this year, simply because of that regulatory review. It was originally due out in December. Now it's due out at the end of this month, but it could be delayed again. What do I think will be the effect of the French and German elections? Oh gosh, this is really where I do need a crystal ball. I mean, again, ultimately, I'm tempted to dodge the question and say I try not to get hung up on politics. I know I've talked about Trump, May, and Abe a lot in the last 25 minutes, but they're only here 4 to 8 years. An equity, a really long-term holding, is a minimum of that. So yes, they can have short-term impact, but their long-term ability to really profoundly impact corporate cash flows and profits, I think corporate management, corporate balance sheets, and corporate strategy will probably bring more benefits or do more damage if they get it right or if they get it wrong. Nevertheless, there's no doubt about it. People will get jittery going into the Dutch election in March. The French elections in May, the German elections in September, October, and if there's a fear that an anti-Euro candidate will win, Le Pen, Wilders in Holland, Le Pen in France, or Frauke Petry, an Alternative für Deutschland in Germany, then the euro would wobble, and I think that would put the lid on European stocks, which are probably the value pick for this year. Looking at all the broker year beginning previews, lots of enthusiasm for the US, lots of value hunting around in momentum for the US, value hunting in Japan, value in the UK on the basis of the exporters. Nobody even talked about Europe. Nobody told me it was rubbish. Nobody told me it was good. Nobody even talked about it. So that's probably the value call for this year. But yes, political uncertainty could stop some of that being unlocked. But in the end, I think you've got to look through it, because there are still some great companies in Europe that will just keep on making good profits and rolling out cash almost irrespective. If you were really nervous, perhaps you'd like to hedge your euro exposure or buy a unit in a fund that comes with sterling domination to try and iron out any currency worries that you would have. The downside there is clearly A, you could be wrong and they might all lose, and B, those funds do probably charge a higher fee than a vanilla one which doesn't currency hedge. Would I hold absolute return funds in a balanced portfolio, and what percentage? This, unfortunately, is going to depend upon your own personal financial circumstances. I can definitely see their advantages, but again, you're clearly going to have to be fairly risk tolerant, and overall, there probably wouldn't be a massive percentage of your portfolio unless you can take a very, very long-term time horizon and come through the odd bout of volatility, but they certainly have their potential role. I do believe in multi-asset funds. You've all heard me talk before about as well. You've all heard me talk about the cockroach portfolio, and that's a kind of a quasi-absolute return fund. So yeah, and then none of us can take relative outperformance to Sainsbury's. So I can see the role of absolute return funds, but again, you've got to have faith in the manager, faith in the process, and make sure it fits with what you're trying to do in the long term. Will the presentation be shared? Yes, I can see no reason why not. We can take care of that if you let us know that on the feedback survey, or alternatively, just email me directly, russ.mould@ajbell.co.uk. I'll send it to you myself this evening or tomorrow. In 2017, what might be a safe bet and what might be a punt? What a lovely question, and what a beggar of a question. A punt, oh dear. I think Europe's the punt, as I've said. And please don't think this is financial advice, but it is the area that nobody's talking about at all. And I think within that, banks and financials are the puntiest of punts, not just in Europe, but in the rest of the world as well, UK, US. If you're looking for a safe set of financials, probably the US. If you're looking for punty financials, I'd go for European ones. Even if there are quality European financials like ING, the Scandinavians that pay fat yields have got balance sheets that look pretty good, but clearly you've got the Italians and the Greeks and the Spanish that don't look anywhere near as good, sort of evening things out a little bit. Safe bet, I mean, again, that's all a matter of relativity. I think that, again, what I would look to do there is probably quiche out and look for a deep value fund where, you've got some degree of safety. I know DeBell's M&G's done well, but Alistair Mundy runs some deep value funds. They'd be kind of things I'll be looking as a, quote, safe bet on the grounds that their process and philosophy should build in a degree of downside protection anyway if things do go wrong. How do I prepare my portfolio for potential correction? Do I lighten up now? And again, this is depending on your time horizon. If you're a young gentleman or a young lady, 25, 30, 40, I mean, I'm only 47, I don't view myself as old. I mean, I'm investing, my money's run discretionary, by the way, just not only think I'm taking the mickey talking about things that I own, it's all outsourced. But my people are running my money on the basis I'm going to cough out at 85. That's 40 years. So yes, I can worry about a market increase now a little bit, but do I really want to personally go through the pain of having them sell everything and then buy it back, incurring all those fees? No, not really. So as long as you've got a portfolio that enables you to withstand any volatility, you don't need money and have to sell at an inconvenient moment, i.e. when the market's gone down, and you can afford to take a 10, 20, 30-year view. It's up to you, but do think if you want to play tactically, you are going to incur costs, you may incur tax, you will pay spreads, you will pay stamp, and that will incur costs. And also, you're making two decisions. When do I get out and when do I get back in? So you're making it doubly difficult for yourself. So if you want to be tactical, it's up to you whether you want to do that, but think of the costs you're going to incur and what time horizon you're really investing over. Can I recommend suggest a shock-proof portfolio for those who are nervous? I didn't put it in this presentation because I didn't want to bore you all, but I have talked about the cockroach portfolio before. It was designed by Dylan Grice, a strategist when he was at Societe Generale. It's a 4-bucket equal portfolio, rebalanced once a year, 25% good quality bonds, if you can find such things, 25% high yielding equities, equity income, 25% physical gold, 25% cash. Now, at any one stage, one of those is going to set your teeth on edge, possibly two of them, but that's the whole point. It prepares you for inflation, it prepares you for deflation, it prepares you for stagflation. And over the last 25 years, having developed my own version of it using funds and investment trusts, back tested it, rebalanced it. I think it's had, from memory, 2 down years in 25. It hasn't quite caught up with the FTSE All Share or the S&P 500, but the volatility has been lower. Returns have been positive in absolute and in real inflation adjusted terms. Clearly, at the moment, you'd be worried about cash, you'd be worried about bonds, you might even be a bit on edge about gold, you'd be very happy about the equity bit. But nevertheless, a year ago, you'd have been very worried about equities and very happy with bonds. That's the magic of the cockroach. Not saying it's going to work all the time. It has had the odd bad year, but it's generally so far back tested pretty well. One leading investment house said global markets have got ahead of themselves and recommended selling on the day of the 20th of January. Would I agree in the short term? Again, I'm not so good on the short term. It's possible. I mean, I wouldn't be shocked, given that things have gone up in a straight line. If there was to be a bump, if you were to say to me normally, the VIX is at near its all-time lows, US market capture GDP is its all-time highs, investor bullishness is high, stocks have done well, yes, I'd be naturally nervous. And you can never be complacent. And I think there will be, to me, it feels like 1997, 98, where things are really about to have a big blow-off. But remember, in 1998, there was a horrible 20 to 25% correction on the back of the Asian financial crisis. So the fact that volatility is so muted, applying Minsky's principle of stability breeding instability, because people just get cocky and confident and take on more risk than they should, there is inevitably going to be a wibble wobble at some stage. I don't doubt it. But all I can do is go with the view of Peter Rogers of Peter Lynch of Fidelity, that in the short term it's very hard to predict where share prices are going. In the long run, you know that the company's share price is pretty much going to follow growth in profits and growth in book value. So on a 10-year view, you can be pretty confident if you assume the economy is not going to turn Japanese. On a 1-month view or a 1-year view, it is very tricky. So again, if you want to be tactical, do, but be awfully careful on the costs that you incur. My kids have got enough Lego in their bedroom as it is. They don't need any more because of the commissions that you're going to pay us. What would it take for sterling to rise in value? Great question. Good contrarian thinking. I mean, I think the quickest thing there would be if Mark Carney and the Bank of England's Monetary Policy Committee were to be a little bit less dovish. Don't forget their last move was down in interest rates. They even talked about another cut to 0.1%. That talk's gone quiet. I think what you would probably need to see either is Mr. Carney change his mind and start saying, actually, this wage growth thing is getting a bit exciting. We need to be on our guide for rate increases. Or, using terminology that Prime Minister Theresa May doesn't like, you get a soft Brexit or a transitional trade deal that just allays the market's worst fears. I think then sterling could surprise, because let's face it, it's beaten down. Expectations are very low. I mean, the UK still has, a combined budget deficit, current account and trade deficit that would make a banana public embarrassed. So in that respect, you'd need to see an improvement in some of the UK's fundamentals and particularly exports, which, funny enough, you haven't seen yet. But if you did see a big pickup in export activity helped by a weaker sterling and or soft Brexit and or Carney talking a little bit tougher, those are potential catalysts for sterling, and that in turn could then perhaps stoke interest in the UK's downtrodden domestic sectors, general retailers, REITs, real estate investment services, for example, that have struggled. Did I see your place for index-linked bonds? Yes, I mentioned that earlier on. I'm sorry if I was talking too quickly. If you think the Trump trade is a winner, and Jonathan Ruffer, for example, has got a big position in index-linked bonds in his portfolios. He writes about them at length in his blogs and his investor presentations. Yes, if you do believe in the Trump trade, the wage inflation and the inflation trade, that is one way of doing it. They're not easy to, unfortunately, access as a private individual, but there are funds that specialize in index linkers, inflation proofing, and again I mentioned the M&G Global Fixed Floating Rate bond fund that again, if that's your personal view, then that might be worth looking at. Bearing in mind the share price growth of FTSE companies with overseas earnings, why were so many FTSE CEOs speaking out in favour of Remain? You probably need to ask them that, but I think in the end they obviously took the view that economically in the long run that Brexit would do damage to the UK economy. I've got lots of friends who work in the market who will remain. I've got lots of friends who work in the market who will leave. The Remainers generally are of the view that you won't feel the pain from Brexit for 5 or 10 years, and that you'll feel the real pain when companies look to start, do we refurb or do we exit refurb facilities that we bought, that they built 5 years ago. They're going to be 20 years old in 10 or 15 years time. That's when they think the real pain will come. And at the moment, why is the stock market going up? Because we haven't had Brexit. We've had the referendum result, but we don't know what Brexit's going to be. So it's post-referendum, pre-Brexit is where we are right now. And in the end, the economic data has held up pretty well. Sterling has been a shock absorber by going down. Bank of England was proactive. Whether it needed to be or not, I don't know. We'll find out. But I think that's why the index, the stocks have done so well. And in the end, frankly, I'm actually quite glad that company CEOs have not predicted their share prices correctly, because it's their job to manage the assets of the business to generate the best return, not to manage the share price or even predict where it goes. That's not their job. I mentioned emerging markets. What's my feeling for Asia in 2017? I think Asia is interesting. It's not had a lot of press. I mean, it's very tempting for me to be lazy and just call Asia Asia. There are clearly huge differences between Taiwan, where you've got political issues involving President Trump in the short term, Korea, where the president's facing impeachment, where you've got huge exporters, a huge export powerhouse, but a market that does badly when the Japanese yen goes down. You've got the Philippines, where President Duterte is managing to upset pretty much everybody and seems to be putting the cramps on the economy. You've got the Indian experiment with almost a quasi-cashless society. So there's all sorts going on in Asia. To say that it's all one homogenous market would be inappropriate, but I haven't got a lot of time. So I think Asia overall, like most emerging markets, isn't expensively valued. It has done badly. It's got some brilliant individual companies. And what I think you probably need to do with an Asian fund manager is not look at one who faffs about with Asian macro, but one who just focuses on some of the really high flying leading companies in their fields out there. Matthew Dobbs' Schroders Asia Fund, for example, is a great example of that. It's not a recommendation, but that's what he does, for example. There is potential, and also income potential. Lots of Asian stocks now pay 4% dividend yields or more, something that's definitely been neglected. If I was a betting man, yes, I am, and I'm very disappointed to hear the Jockey Club may be demolishing Kempton Park, apparently, according to a press release they've sent out today. If I was a betting man, how low do I think the FTSE 100 will go in 2017? The edge about we've got an internal, we've had an internal chat here. In December, we drew up a FTSE 100 forecast for the year for what it's worth of 73.50, thinking we were pretty smart. When index was at 6,800 because that was a 10% total return, including the income. And let's face it, 10% from equities when bond yields are 1.3 and cash is 0.25, that looks pretty awesome. Doesn't look so generous now with the index at 72.70, wherever it is today. If things went wrong, hey, I mean, the index went from, let me have a think, sort of, 6,400 to 5,600 a couple of times last year. It's very easy to get 10, 15, 20% backdrafts without too much fuss. So that's always a fair benchmark. What could cause that? Disappointment in the Trump trade would be the key one. I would think a massive rally in sterling would potentially upset the apple cart. But I think in the end, disappointment in the Trump trade and fears over UK growth would be the key one there. Keep watching the purchasing managers indices, the lead indicators. Keep watching the concurrent indicators, industrial production and retail sales. Don't get too hung up on unemployment. It's a lagging indicator just because of the lead time involved in hiring people. What's my view of Europe? I think we've given the elections, I think we've slightly touched on that one already. Again, there's definitely scope for volatility caused by these Dutch, French, German elections. And yeah, who knows who's going to win? Wilders is in the lead in France, in the Netherlands. Le Pen is in second in France. Merkel seems to be in the lead in Germany, but who knows? Yes, it could create volatility unless there's an Italian election and the Movimento Cinque Stelle win, and if Le Pen wins, if they win, then there will be existential fears over the breakup of the Eurozone and people will be running for cover, and that's why you may want to think about hedging euro exposure through funds that offer sterling denominated units in the knowledge, A, you may be wrong about the euro, B, those elections may go the way of the pro-euro parties, and C, those funds will probably charge you more money for the privilege. Gold, silver and platinum. I think platinum I know almost as much as nothing, to be honest with you. But I do know obviously the strikes in South Africa curbed production last year, drove prices up. I guess if you're a long-term believer in electric cars, you're probably not too thrilled about the prospects for the platinum price. Gold and silver, to me, feel like dead money at the minute. It's intriguing that you've had the Trump trade and they haven't really participated. I guess silver you would expect to participate perhaps more fully than gold. Gold is almost a play on central banks going bananas with interest rate, with QE and running it for a lot longer than people think. They've both sort of gone flatlining, and I think until faith in the Trump trade ebbs, I think that's likely to be the case. If faith in the Trump trade ebbs, or you get a big market correction, central banks step back up to the plate, then I think gold and silver will do really well. And I think if you then want to know which one, then you probably go silver over gold, because you look at the gold-silver ratio, divide silver into gold, I bet it's around 70 right now. The long-run average is 55. So in principle, silver is cheap relative to gold, but I think you need more strident talk of central bank action and monetary stimulus rather than the Keynesian talk that we're getting right now for them to really get back into the box seat. UK residential property in 2017. Halifax House Price Index was good yesterday, up about 6.5%. Clearly, it depends where you are. In London, there's obviously talk of discounting at some of the biggest new developments like Nine Elms, for example, that people like Berkeley Homes have been talking about. You can see it in the house builder results that the southeast has gone a little bit quieter. There has been a little bit of anecdotal discounting there. But weak sterling, if I was a Russian oligarch or an Arab sheikh or a Chinese entrepreneur, the weak sterling thing for me is a big plus. And if you're looking to get assets into the UK, now is as good a time as any. So I would personally be reluctant to go too overboard on calling a crash in UK housing market, because I think there's pent-up potential supply there attracted by a weak pound. Equally, I don't see UK interest rates tearing up that quickly. I see the market therefore as relatively fairly underpinned. But yeah, there's no doubt about it. If you're a first-time buyer, I'm not pretending it's easy out there, because it certainly isn't. And I think that in itself means that it's unlikely that house prices are going to go bananas the other way. There aren't many ways of playing residential UK property. Don't forget the house where you live. You can't take the bricks to Sainsbury's. So in that respect, it's not an investment. If you want to play residential property, there is a Hearthstone fund that you can do it through if you really want to. But yeah, sterling I think is potentially support for the market. Yes, you do have to be wary of the long-term impact of Brexit. That will take a long time to play out depending on how it plays out. So it's probably okay this year, but rising interest rates will certainly cool the market if and when they happen, if history is any guide. Multi-asset funds to prepare for all options. Yeah, it's as good a way as any. I'm not saying it's perfect. Marcus Brooks at Schroders, for example, runs some interesting multi-manager funds. They're definitely an option to consider. They can be quite expensive, so again, keep an eye on the fees. And obviously, you've got to put your faith in the fund manager getting the right assets and the right geographies at the right time. So there are no guarantees, but yeah, the cockroach is kind of the cheats way of doing it. You can do it yourself relatively cheaply, but that's not, again, that has its lumps and bumps. So I can see why they would be part of a balanced portfolio and could do some of the heavy lifting for you there. But again, be aware of the fact that there are costs involved. Why are forecasters so negative about the UK? Well, I know lots of people, I've got friends who live abroad, do think we're a bit of a nation of mourners, which may have something to do with it, although equally the weather probably doesn't help. Switching to world trade terms. I mean, that's the long-term plan of the Brexiteers, is strike new trade terms. You know, we already have existing trade deals, so the Remainers will be saying, well, what the hell are you doing? We don't need new trade deals because we've got them already. But the principle is we could strike new ones. America has already said that we're at the front of the queue. Obama said we're at the back. Trump has said we're at the front. Fine, let's see what happens. In the end, we don't know. And I think that's why, again, to answer a previous question, the market's been so strong, because we're post-referendum but still pre-Brexit, and nobody knows. And what, in the end, the only decision you can make is when you're looking at a stock or a fund manager's stock picks is what do you think is priced in, because that's going to be the key determinant. If you think disaster is priced in, it's not going to happen, you might think those stocks are cheap. If you think actually this is all going to be a disaster and it's not priced in, you may go the other way. But I think the question mark that people have got is how long does it take to decide these trade deals and on what terms? What's my view of the UK investment landscape if there's a second Scottish independence referendum? Now, I read in the pink paper today, the FT, that Nicola Sturgeon is not thinking of a second referendum on the grounds that Scottish public opinion, and I say this as somebody who lives in Brighton, so I could hardly be further away from the coalface. So if I'm upsetting any Scottish listeners, please accept my apologies. From what I read in the probably Anglo-centric newspapers, is that the Scottish independence polls suggest that, or Scottish opinion polls suggest that there's no more support now necessarily for independence than there was on the previous referendum, and therefore the SNP leader Nicola Sturgeon is stepping back for pressing immediately for a new vote. Equally, if there is to be a hard Brexit, Ms Sturgeon clearly argues there is a strong Remain camp in Scotland, and that may be the trigger. Well, we saw what happened with the last Scottish referendum. UK equities wobbled going into it and rallied very hard coming out of it. You know, an existential threat to the union would again create political short-term volatility, because we don't know what it would mean. It would affect some companies harder than others. Those with big Scottish operations, the Oils, BP, Babcock International, Aberdeen Asset Management. I'm sure they've all got contingency plans, given that they've been through this now already. Nevertheless, it would be an additional layer of short-term political volatility for an index that's done very, very well. But again, what the result would be at the moment, the polls suggest another Scottish vote to stay as part of the union. Again, therefore, you'd potentially get the rally we got last time. Let's see what the opinion polls say. Some investment experts suggesting 2017 is a good time to return to value investing. Yeah, it's worked incredibly well. I mentioned Tom DeBell's M&G Recovery Fund, one of the ultimate value funds, noted as a spot the dog by our as our rivals at Best Invest have pointed out regularly. It's now top decile. Alistair Mundy, Invesco, and Temple Bar Investment Trust is having a good run. If the Trump trade continues, cyclicals, turnarounds, value is probably where you need to be. If you think that that's going to all go wrong and the market's going to dash back to quality growth, then things like Threadneedle European Select, Jupiter European Opportunities, for example, would be the kind, Alex Darwell would be the kind of funds that you'd be looking for, because they're packed with quality growth names. Fundsmith, Terry Smith, he's not going to change his philosophy. He's packed with quality global growth names, things that you may have pejoratively called expensive defensives. He's not going to flinch if he has a slight year of underperformance. He just isn't, because again, he knows that changing his mind and chopping and changing brings expenses, lowers the returns he offers to you as investors. But nevertheless, in the short run, the market at the moment is in value mode, yes, and will remain so if the Trump trade plays out. And the great thing about value is if it all goes wrong, because these are downtrodden stocks that are probably cheap on PE or dividend yield or most likely price to book or price to sales, you should in theory have some downside protection in there anyway. But I stress, in theory, what you mustn't do with value stocks is pick companies that are cheap for a damn good reason, which is they're dying, operating in a dead industry or a really brutal industry. Will Italian banks bring down the EU? They're capable of it, and I don't believe that the 20 billion euro package that's been put forward is enough. Monte dei Paschi di Siena has already burned through 8 billion euros since 2011. The Atlante Atlas rescue program organised by former Prime Minister Matteo Renzi of 5 billion euros, well, that wasn't enough. Am I convinced that 20 billion is enough? No. Italy's got at least, according to the FT, 250 billion euros of non-performing loans. You're assuming some spectacular recovery rates on those to assume that 20 to 25 billion is enough to prop up the system. So if there is a fault line in Europe, you're quite right. I'd be more worried about Italy's banks than I would be about the general elections this year. What about the older investor? What should they do? This is a really important question because it comes down to time horizon. The older you are, the less time, unfortunately, you potentially have to come through any period of volatility. I think maybe here what you need to think about is, again, and this is a kind of holistic financial planning exercise, either do it yourself or helped by an advisor, depending on which you prefer and your personal circumstances and what you're prepared to pay or willing to pay, is American modern pensions theory says that you shouldn't worry about the size of your pot, just the income that you generate from it. So therefore that you should have 4 pots: your day-to-day financing needs, your life's essentials, your life's little luxuries, and a contingency pot. And so long as the income that you're generating from your portfolio covers at least the first two and hopefully a bit of the third one, and with a little bit of luck the fourth one, you're okay, and you don't need to worry too much about the value. It's the income that comes in. It's almost like it's an immunization strategy that you would run if you were running a life assurance fund. You know you have liabilities at the end when people die or you pay out on pensions and insurance policies. You just need to make sure there's enough money coming in to cover what you've promised to pay out. So in that respect, that may be one way of easing any worries that you have. Again, it depends on your personal circumstances, which I'm not privy to and nor should I be. But if you are worried about capital, then at least making sure that the income generated is coming in at the right time, quarterly, semi-annually, whenever you need it, and in the size that you need to cover life's essentials and a few bits and bobs, then even then you may be in the blessed position of not having to worry too much about the capital value. Because I think there will be a bump at some stage. It seems fairly inevitable, but like 1997, 98, there was a big bump, then it got ignored. So I can't guarantee when it will be. Both equities and bonds fell after the September 11th attack in New York and again at the start of the global financial crisis. What's the possible impact of the global spread of terror foreseen by David Gardner in the Financial Times? Yes, short term, if there is a major attack on a major financial centre or major capital, 9/11 markets moved down by 10-15% straight away. The Great Financial Crisis wasn't a terrorist situation. It was an implosion, a self-inflicted wound by the financial system. That was a bigger issue. In the end, as unpleasant and horrible to contemplate as terrorist attacks are, and we've seen them in New York, London, Bali, Morocco, Egypt, it's a long Thailand, it's a long and unpleasant list. Their impact on economies and tourism is astonishingly short-lived. And if you look at the UK, in New York in 2001, London in 2005, tourism flows bounce back incredibly quickly, as they've done in Bali. It's been different in the Middle East, I'll grant you, and that's been a problem for people like Thomas Cook and the airlines. But certainly in major Western developed cities, the hit is Madrid, for example. Paris, the hit has been relatively short. So yes, it's nasty. Yes, it's bumpy. But in the end, it has nothing to do with corporate fundamentals of profits and cash flow. So in that respect, looking at it in a very unpleasant and callous and cold-hearted fashion, I admit, it might not be that big a deal despite the human misery that's involved from a strictly investment perspective. Well, A, you hope they don't happen, but B, if they do, they might not have that lasting impact because in the end it comes down to cash flow and to valuation. Do I see interest rates going up? I'm not. The Trump thing has changed the Federal Reserve's attitude. We've got 2 US Federal Reserve governors stepping down this year and Trump gets to appoint them. And next February he gets to appoint the Federal Reserve chair and vice chair. There's no guarantee he will reappoint Janet Yellen and Stanley Fischer because he's been openly critical of Fed policy and the effect of low interest rates. I think this has partly changed Fed thinking. Trump has openly said he believes that low interest rates are bad for the economy, that they create asset bubbles and create economic instability. And I think the Fed's taken that message on board. It's been obsessed looking at unemployment numbers, which is a lagging indicator. So I think there is, a chance that the Fed will show more courage this year than it's done previously, even if the market at the moment does not believe it will put through 3 interest rate increases simply because it's promised more in the last 2 years and delivered nothing. I don't see Japanese interest rates going up in a hurry. I don't see European interest rates going up in a hurry. The UK, maybe, but again, very, very slowly. I think, however, that said, if the Trump inflation trade pans out, the bond vigilantes will run over the central banks anyway and take bond yields higher with or without them. I think we're running out now. Is the FTSE 100 really sustainable at current levels? Is it based on true earnings or market psychology? Benjamin Graham, in the short term, the stock market is a voting machine. In the long run, it is a weighing machine. Right now, sir or madam, the market is a voting machine. It is deciding that Brexit can be weathered. It is deciding that low sterling is good. It is deciding that Trump and strong dollar are good. That's the vote. You're quite correct. We have yet to do the weighing. What does it mean in terms of long term, and I stress long term, 5 to 10 years plus, profits and cash flow? At the moment, as I showed on my chart, UK corporate profits as a percent of GDP are at a record high. That is how you can justify the FTSE 100 where it is today. But you need those profits to stay there or go up to justify further substantial increases in the FTSE 100 on a sustained basis. It could easily shoot because of the voting short-term sentiment and then shoot back again. Could easily do that. It's done it before. 1998 to 2000, 2005 to 2007, 1986-7. Anything's possible in the short term. That's why second guessing it's a dangerous game. Sticking to long-term dividend growth, profit growth, book value growth, and cash flow growth, that's where the action's at. I think we're going to the last question. What are my thoughts on retailers suffering? Is it due to a change in customer behaviour or weakness in the economy? What a brilliant question to finish on. I think it's 6 of one, half a dozen of the other. As somebody who used to buy pants and socks from Next and doesn't anymore because they fall apart within less than 12 months, I think personally from my own pragmatic experience, Next has got a quality problem. And if Lord Wolfson you're listening, and I doubt it, he'll be very offended by that, but that's just a personal opinion. Equally, I think Next is suffering because it used to make a lot of money from its directory and the credit that customers took out with them. Now they're buying more directly online. I think that is less of a boost for them. And yeah, they have a lot of shops and high street is tough. The company is talking about 5% price increases this year in an extremely competitive market. I'll be intrigued to see how that gets on. They're expecting around a 5.5% volume drop on the back of it. So I think it depends on, are you bricks or clicks? Have you got your product right? Have you got your mix right? Have you got your price points right? Look at B&M European Value Retail. The same day that Next dropped a stink bomb, its shares were up 10% because it massively surprised on the upside. Look at Morrison's today. It used to have, I think, according to Mr. Potts, the chief executive, used to sell about 12 different types of balsamic vinegar. Now, they're from Bradford, and I'm a Yorkshireman, but I'm not sure the punters of Bradford need 12 different types of balsamic vinegar. And lo and behold, now they're selling one. He's freed up an awful lot of cash from all of that working capital and unsold stock, and the debt's coming down. And if debt comes down, risk comes down, and if risk goes down, shares tend to go up. So I know it's a bit of a stretch. Balsamic vinegar equals Morrison's share price going up, but it's indicative of what he's trying to do. And it's indicative of what these companies can do for themselves. There's no doubt about it. It's tricky out there. You with an internet-savvy, price-sensitive customer base who are no fools. With great transparency on pricing, they can walk into any shop, log on to any phone or tablet and compare. That does not make it easy for retailers. But you get your stock right, your product right, your price points right, your means to market right, it can still be done, but it isn't easy. And again, branding is obviously very important there. There are some very cheap retailers out there. Card Factory, you're not going to tell me that selling greetings cards and tinsel and little things is very exciting, but it's got a low debt, it's got a strong balance sheet, chucks out plenty of cash, it's got a couple of competitors who aren't doing very well, and if it pays out another special dividend this year, that's a 10% dividend yield stock. I say if it doesn't pay out a special dividend, it's still a 3.5% yield stock. There are probably far worse places to be. So it's very much stock by stock, but the other big thing that could happen is, yes, if wages outpace inflation, that's good. If sterling goes up, funny enough, that's probably good for the general retailers, given that it eases some pressure on their input costs. Thank you very much, everybody, and I hope I haven't kept everybody too long from their loved ones. But yes, the gentleman pointing out that Alex Money is at Investec and Investco. Well, thank you very much indeed. You're quite right. Thank you. So just in case anybody's listening, that is quite right. So thank you. There's one more question there coming through. I will reply to that one personally. So thank you very much for all of your time. Please do fill in the feedback forms. We will then get the presentation to you. If you need it before then, email me directly at russ.mould@ajbell.co.uk. And may I wish you a happy and prosperous 2017.